All right, talking more in depth about the termination of a partnership. This is disassociation. Now, we kind of mentioned this earlier, but we're going to dive into it much more in depth. Disassociation refers to the change in the relationship between partners that occurs when a partner ceases to be involved in the ongoing business activities. Now, this event does not necessarily lead to the dissolution and winding up the partnership. Now, these terms essentially mean the same thing for our purposes right now. Dissolving the partnership and winding up, which it's actually you think, oh, winding down the partnership, but the process of winding up is essentially that process of closing down shop. In a partnership at will, which is one without a specified termination point, because you can have a partnership that has a specified termination point. Maybe I create a 5-year partnership with someone because at that point the project will be done and we don't need it to be going on past that point. So as such, there is a specified termination point. But generally speaking, there's probably not going to be. I mean, think about the accounting firms that are all partnerships. They don't really have a specified termination point unless they secretly do, and they should probably tell everyone about that. Now here, any partner can rightfully dissolve the partnership by providing notice of withdrawal or disassociation at any time. Now, what is going to actually happen here? A partner can disassociate from a partnership due to various events, and these events can include providing notice of withdrawal. You're saying, I'm getting the heck out of here. They die. That is also, as we talked about, a way for this to happen. Bankruptcy of the partner, and we'll dive into bankruptcy law in its own lesson. Expulsion of a partner, whether it's through, maybe a bunch of other partners don't like the partner, or this partner actually did something wrong or illegal or contrary to business practices. For whatever reason, they vote to expel the partner. And then lastly here, we have occurrence of an event specified in the partnership agreement as a cause for disassociation. So maybe in that partnership agreement it says, if anyone starts not pulling their fair share, then they get the boot and they are disassociated. Now, what are the results here? When a partner disassociates from the partnership, they lose their right to participate in the management of the business. However, their apparent authority to bind the partnerships in contracts and agreements continues until third parties receive that notice of disassociation. That's incredibly important, as we've seen it a few times and we'll continue to see it. Generally speaking, with agency law, you need to provide notice to any reasonable third parties that this person is not going to be able to conduct business on behalf of the partnership. I think a good classic example is, and this is something big, right, that you'd probably hear about. Anyone can relate to this. There are other examples, but not that we can relate to. But let's think a big company, say Apple, Microsoft, Tesla, the CEO of those companies, you would think generally that they can enter into contracts on behalf of the company. However, what happens if that CEO is fired or quits? Generally, you hear about it on the news, and they make that public on purpose because let's say that's not public. So let's say the CEO of Microsoft, right, is either fired or quits, and then the next day enters into a contract on behalf of Microsoft. Now, again, that would be illegal on its own, and that person would face their own separate lawsuits. But that's important for apparent authority, which again is dealing with agency law, so might as well beat it to death now and get it down. You want to make it clear to all possible third parties, even third parties you wouldn't possibly think of. So by blasting it on the news saying, oh, the CEO is out, that is letting everyone, in the general public know, hey, you cannot enter into any contracts with this person. This person is no longer the CEO of the company. Now, in other situations, you may only need to tell just the reasonable third parties you'd expect that person to have done business with, not just the general public. But again, that is diving into more agency law. But this does impact what we see here because partners are agents of the partnership. What disassociated partners' liability to other parties? Well, the disassociated partner generally remains liable for the debts incurred by the partnership before the disassociation, unless the creditor releases them from the liability or innovation, which is the substitution of a new agreement. Hey, that's a fancy, nice business law term. I would definitely memorize that here. You'll have plenty of opportunities to memorize it going forward, but that's what novation is. And generally speaking, throughout this exam, if you see novation, it means we had an agreement and we replace it with a new agreement. That's all that is. And that's a remedy in a lot of cases of legal conflict. Now, lastly here, a disassociated partner can be held liable for debts incurred by the partnership up to 2 years after disassociation, unless they provide notice of disassociation to third parties. Now, if a new partner joins the partnership, the new partner is generally not personally liable for debts incurred by the partnership before becoming a partner. That seems just fair. And also, we don't want these partners to just disassociate, get out of there because they knew they screwed up and they had a bunch of contracts and liabilities that they'd be liable for. So that's kind of clawing them back, making sure they're being held responsible for whatever they should be. All right, dissolution. We talked about disassociation. Now we're talking about dissolution. Dissolution is going to refer to the process of ending a partnership, which typically involves winding up, which I know I said you think it's winding down, but no, the term is actually winding up the partnership's business affairs. Partnership may be dissolved for various reasons, such as if it was a partnership at will, if the partnership has no expiration date, it can be dissolved when a partner gives notice of withdrawal, a mutual agreement, the partners can agree to dissolve the partnership, and or a court order. A court can order the dissolution of the partnership under certain circumstances. I mean, this could be anything from it's conducting illegal activities to, I'd say literally anything, so don't think about that too much. In some cases, the death of a partner does not automatically lead to the dissolution of the partnership. Now remember, a partnership, let's think in its more simple terms. Let's say two people come together. If one person dies, well, for many reasons, you can't have the partnership. One, because there's only one person now, but also it is not the original partners. So we'll also talk about later on what happens if you have a partnership with three people, one person dies. Is it still legally the same partnership? Not really, but we will talk about that more. Now, if the remaining partners agree to continue the partnership within 90 days of the partner's death, the partnership can persist. And this is kind of what we're referring to. If we have a partnership with three partners, one dies, the remaining partners can agree to continue the partnership within 90 days of the death, and it can continue on. There are like weird, not exceptions, but just other points to cover dealing with that topic, which we'll just see sprinkled out throughout partnerships. Now, a key characteristic of a partnership is that its duration is not unlimited. Any of the events mentioned above can trigger the dissolution of the partnership. That's an important point. It's not unlimited. Something eventually will happen that will make it so the partnership either ceases to exist or needs to be essentially renewed. Whereas for a corporation, it just goes on and on and on. There's nothing inevitably that will happen that will make the corporation need to cease to exist. If the company eventually goes bankrupt, I mean, company could go on for 300 years and never declare bankruptcy. It could be totally fine, right? So that's the difference between a corporation and partnership. So overall, however, the partnership does not cease to exist immediately upon dissolution. Instead, it will continue to exist during the winding up process, which involves settling the partnership's business affairs, such as paying off debts, liquidating assets, and distributing the remaining assets to partners. This is something you'll see questions on as well, not in this lesson, but when we get to the partnerships lessons, where we'll see first off, you pay off the debts. Then once the debts are paid off, what is remaining to distribute to the partners? And then we determine what is the gain realized, recognized, the basis of the assets partners get, all that great stuff. Now, during the winding up process, partners still have apparent authority to bind the partnership, and each partner remains liable for the obligations of the partnership. The partnership is only going to be considered terminated when this whole winding up process is complete and all the partnership's affairs have been settled. And lastly, all third parties must receive proper notice to terminate apparent authority, similar to agency law. Well, similar to agency law because this essentially is agency law. Yeah, it all is nice interconnected with itself. And this makes sense as well. During the winding up process, you still possibly have an office to maintain. So you may enter into a contract with a janitorial service to clean the office. Maybe you need to hire another accounting firm to help you and with the winding up process. So there is reason to enter into new contracts during this whole process. Again, that's why we're talking about what we are. Making sure you're familiar with each step of the way. What are the attributes and responsibilities, rules, and obligations that everyone faces? All right, talking about actually distributing those assets after ceasing operations. Like I said, we will see a lot of calculation-based questions with this when we get to partnerships. But when a solvent partnership is dissolved, meaning they have assets in excess of liabilities, so they pay off their liabilities and there's still some remaining assets to be distributed, the assets are typically liquidated, so resulting in cash. So we don't want a bunch of office equipment and accounts receivable and inventory, right? Anything like that. We just want straight cash to then use to pay off the partner's liabilities in specific orders. So just to pay off the partnership's liabilities as well as the partner's basis, the remaining basis, which is their investment in the partnership. This process ensures that the partnership's debts and obligations are settled before any remaining cash is distributed among the partners. First, we're going to pay off creditors, and you can kind of think of this like a similar process to bankruptcy. Now, it's a solvent partnership, so this is not bankruptcy, but this is generally kind of the process that we go with here. If an entity were to go bankrupt. Now, it's different because a lot of times there's nothing left after the bankruptcy process to give to the owners. But if you see a similarity here between this and bankruptcy, you're not crazy. You are totally in the right. Now, paying creditors, first step, again, in any dissolution of an entity, you pay off the creditors. You pay off the debt holders. First step, you got to pay off those creditors, including any partners who have loaned money to the partnership or are owed money by the partnership in their capacity as creditors. Now, these debts must be settled before any non-creditor partners receive any payments. Then we have to return partners' contributions. After all obligations to creditors have been satisfied, each partner is entitled to receive a payment equal to their initial contribution to the partnership. This payment is going to be meant to reimburse the partners for the capital that they initially invested in the partnership. Now, just keep in mind, at a certain point, the money could run out, and we're not moving on to step 2 or step 3, right? So that's one thing to note. Distributing profits, well, once the partners' contributions have been returned, their initial investment has been returned, any remaining money will be considered profit. Now, this profit must be divided among the partners unless the partnership statement says otherwise. We're going to divide everything equally. But the agreement may say something different, in which case we would follow that. However, what about losses? If the assets at dissolution are insufficient to pay off the creditors, so we're maybe insolvent, we don't have enough assets to pay off the creditors and return the partner's contributions, the partnership has incurred a loss. Shocker. In this case, the losses must also be divided among the partners. By default, losses are divided in the same manner as profits, which is equally among partners, unless the partnership agreement specifies a different arrangement. All right, we're going to see an example here. Again, you're not going to see questions tested in this lesson about this, but you'll see this when we get to partnerships. And so if you want to view this as kind of just a visualization of how this works, great. If you want to use this to get a jump on like an actual practical numerical based question you can see on the exam later on, also great. Use this to your benefit, but this will be something you have to know how to do on the exam. Now, we're considering a hypothetical partnership between John, Alice, and Bob. They formed that partnership to run a small marketing agency. John contributed $50,000, Alice contributed $30,000, and Bob contributed $20,000 to the partnership, which is totaling at $100,000. Now, after a few years, they decide to dissolve the partnership. At the time of dissolution, the partnership has the following situation. So we've got assets that have been all liquidated to cash. So maybe we originally had $200,000 of assets, but in order to just get the cash, right, we sold some things maybe at losses. We sold our inventory maybe a little bit at a loss. We sold our office furniture a little bit at a loss. And I'm just mentioning that because that could be something that you see. But you want that liquidated to cash amount. What are the liabilities we owe to external creditors? Well, we owe $40,000. And then there's a loan from John. So John loaned money to the partnership of $10,000. And then here it says that profits and losses are shared equally among partners. Very good. We got some great points here. Take note, not really anything too much of a distractor. We are going to follow the dissolution process here. We're going to pay off the creditors. Simply put, we have $130,000. We have to pay down $40,000 of external creditors, and you have to pay down John's loan to the partnership. So we now have $80,000 of remaining cash. Then we have the partner's contributions. But look at that. We have total contributions of $100,000, but we only have $80,000 of cash. So how are we going to deal with that? The partnership returns each partner's initial contributions. Now, after returning the contributions, the remaining cash is actually going to be at a negative amount. It's time to run through some examples. We are dealing with ceasing operations in a partnership. Now, first off, we're going to consider a partnership between John, Alice, and Bob. John contributed $50,000, Alice contributed $30,000, and Bob contributed $20,000 to the partnership, totaling $100,000. Now, after a few years, they decide to dissolve the partnership. And keep in mind, normally you'd have a lot more activity in between the contribution amounts and the dissolution. Here, these are just the normal, the original contribution amounts. We'd have years of profit, years of losses, years of extra contributions and distributions. For the sake of simplicity, we're just dealing with the initial contribution amounts and assuming that is the capital balances at the end of this process. Now, at the time of dissolution, the partnership had the following financial situation. The partnership had $130,000 of assets. Now, keep in mind, this is likely maybe they had $200,000 of assets. That was inventory, that was office equipment. They sold it, tried to liquidate it for cash, and they had $130,000. Why do I say that? It's just something you can see on the exam, right? That's the process. You're trying to maybe sell things at a little bit of a loss in order to just get that into cash. In this case, the partnership owes external creditors $40,000, and it owes John, who is one of the partners, as we see here, $10,000. So that's a loan from a partner, needs to be paid back, and profits and losses are shared equally among partners. Now, we're going to follow our dissolution process that we covered prior. First off, we want to pay down creditors. And what cash do we have? Well, we have $130,000. Pay off those external creditors, pay off John. Cool, sounds good. Leaves us with $80,000 of cash remaining. Now we get to this point and you're thinking, well, we have $100,000 of capital we need to give back to partners, but we only have $80,000 of cash left to distribute. We are in a bit of a conundrum. You would be correct. Now, next up, we would return the partner's contributions if there's sufficient cash to distribute. However, in this case, we don't have enough. And let's see how we're going to treat this. Well, when a partnership is liquidated and there are insufficient funds to repay all the partner's capital contributions, the remaining funds would generally be distributed proportionally to each partner based on their capital accounts. Now, the capital accounts reflect the net contribution each partner has made to the partnership. So this would be contributions of capital minus any withdrawals. Like I said, this would be activity throughout the many years of operations. We are just ignoring that for the sake of simplicity. Now, in this case, we have $80,000 remaining, and the capital contributions did total $100,000. So each partner would receive 80% of their original contribution. So in this case, John, and this would be, if there was activity, and it wasn't just the initial contributions, this would be essentially your basis in the partnership left. John would get $40,000, which is 80% of 50. Alice would get $24,000, which is 80% of 30. And Bob would get $16,000, which is 80% of $20,000. These are the other steps as well, but obviously since there's no money left, we don't have to account for them. We would distribute any remaining profits if there's profits from that, and if there were any losses, but there's no loss allocation needed because we are done. We have distributed all the money. So, yes, in this situation, it kind of sucked for the partners because they didn't get their full money back, but they didn't have any profits. They didn't have any losses overall from the partnership. They were able to pay down their creditors. Let's see another example now with some different changes. All right, we've got another partnership, Jane, Mark, and Lily. Well, Jane contributed $60,000 and Mark contributed $25,000. Lily contributed $15,000 for a total of $100,000 again. After a few years, they decided to dissolve the partnership. At the time of dissolution, the partnership had the following financial situation. We've got assets that were liquidated to cash of $90,000. We owe $70,000 to external creditors, and we have a loan from Jane, which is $20,000, and then profits and losses shared equally. Now, right off the bat, you're thinking, oh, we couldn't even get to the first step really there, because in this case, we have $90,000 of value, and we owe $90,000, so we're probably not going to have any cash remaining to give to the partners. That is not good. The partnership is going to pay off those external creditors and the loan from Jane. So right now, we've got nothing. We've got no cash left to distribute to the partners. Now, in terms of the fact that there is no cash left to return the partners' initial contributions, we, as a partnership, have incurred a loss. Now, there's no profits here, so we're going to jump to step 4, allocating the loss here. The total loss amounts to the partner's unpaid contributions, which sum up to $100,000. This is what you're going to recognize on your tax return. Now, in the previous example, yes, each of them recognized a 20% loss of what they did not get back. That is something we could have covered then, but we're building up to that. So that's kind of, I didn't ignore that prior. We are building up to that one step at a time. So here we have 100% losses. So they're not getting any of their money back. In the prior example, they got 80% of the money back. Here, you're getting none of the money back. Now, losses are shared equally among partners. Each partner would be responsible for this $33,333 divided by 3. However, let's assume that Lily refuses to pay her share of the loss. All right, interesting. We're throwing these new situations, change one thing. What happens? Well, Lily refuses to pay her share of the loss. In this case, Jane and Mark will have to proportionally cover Lily's share of the loss. Now, Jane contributed 60% of the total contributions made by Jane and Mark. That comes from, $60,000 divided by the total from Jane and Mark, which is $85,000, while Mark contributed 40. Therefore, Jane's going to have to cover 60% of Lily's share, and Mark will cover 40% of it. The Lily's share of the loss is that 33. Gotta love those long numbers. So Jane will cover an additional $20,000, which is roughly 60% of that 33, and Mark will cover an additional $13,333. And then we're obviously taking some liberty with the rounding as well. That's going to be 40% of the $33,333. Jane's total loss share becomes $53,333, which is the addition of the $33,000 plus the $20,000. Mark's total loss share becomes $46,666. That's a combination of his 33 and the 13,333. In this example, the dissolution process involved paying off creditors, determining that there actually were losses to allocate, and adjusting the loss allocation due to a partner's refusal to pay their share. This is something you could see in a question. As such, you now know how to do it, how to tackle it. The partnership is now considered dissolved and terminated. Good. Looking good. Next up, we got some special treats for you. Now here we are introducing our tax returns, good old 1065. First off, make sure you just memorize that the 1065 is the tax return needed for partnership income. And what are we demonstrating for you here? Well, first off, the tax return forms, you're not gonna have to memorize that line 13 is rent, no, nothing like that. This is for your own visualization. I highly recommend it. I'll say it every time I bring this up throughout our lessons. Print out these forms. We've also got them linked in the resources. We've got them, you can, if you don't want them through us, Google them, go for it, find them on the IRS website. This is to demonstrate where each item goes on the return. This is one big calculation. You can think of the forms like a way to organize your thoughts that you're going to see for multiple choice question. So for example, if the question is talking about gross income for a partnership, it goes here. We're going to subtract out any expenses. Oh, where do guaranteed payments go? Do they actually go in the face of the 1065? Well, we can see that it is displayed here. And how does the flow all work? So as a partnership, it gets taxed once. It's a flow-through entity. The partnership does not pay tax. It's the partners that pay tax on that income. So what happens is you see a question, there's a bunch of information. I would be generally aware that, okay, well, the business income, the business expenses, they get reported here. We see depreciation, right? We got income, we've got expenses. All right, I'm just getting excited. You can tell I'm just getting way in over my head here. And we are going to get a nice amount calculation. And where does that go? Then that amount goes all the way into our total balance due, into our amount owed over payment. That amount flows to the Schedule K. And boom, look at that. Ordinary business income. That's from page 1, line 22. Let's just go back and take a look at that on the previous slide, which was the face of the 1065. Again, if I say the face of a tax form, it means the front page. So the face of the 1065, the face of the 1120. Additionally, we want to recognize, so let's see, line 22. Okay, ordinary business income, that is going to flow through to Schedule K. Schedule K, this is going to have all of our separately stated items, the total amounts of those. So separately stated items, super important topic. It's going to come up in partnerships in our S Corps. So we're going to really beat that to death there. Keep in mind, these are not all the pages. This is page 4. We skipped from the face, which was page 1, to page 4. These are just the important ones that it's important for you to see and understand. We've got different items here. These are going to be your separately stated items. So all the total business income gets reported here, the total net rental real estate income, all these total amounts. Whatever the partnership did, it goes here. Then what happens is we've got another part of our form. And this is the Schedule L, Schedule M1, M2. It doesn't flow perfectly. I just wanted to have this one here. I'm going to jump to the K1 and come back to this. Then within our big old tax return, there's a bunch of K1s. So let's say there's two partners, 50-50 partners. Half of everything will go here. Half of the business income from the original Schedule K goes here. Half of the net rental real estate income goes here. And just as a note, start memorizing them now. You want to memorize these as separately stated items. So if a question just says, what are separately stated items? Boom, all of these items. And there's a few others. This is not a comprehensive list. But at the end of the course, you'll be an expert at this. But if you want to get a jump on it now, these are separately stated items. And again, why is that? Well, because they are separately stated on another part of the 1065, right? We see this is still part of the 1065. And then these flow through and go to the individual partners, individual 1040. And I'm going to even show you that when we get to partnerships, I'm going to even have more slides and more tax forms showing you the flow all the way until the calculatable taxable amount, how this all flows. I'm going to cut this off here because we're dealing with overall business structures, right? We go more into depth in those individual lessons, but just something to start keeping in mind, getting familiar with the important points of each tax form. Going back over here, this is important as well. You'll see a lot of similarities between the book to tax, Schedule L, M1, M2. This is book to tax. When it comes to Schedule L, this is the balance sheet per the book. So you need a report, just your balance sheet for the IRS's informational purposes. Schedule M1, this is where you reconcile your net income. And then M2, this is going to be where you display your partner's capital accounts. General familiarity here. I'm going to reference these just throughout, again, partnerships and just throughout the rest of the course. Even when we deal with assets and the basis of everything, we'll see how it all ties in. So again, just a good general familiarity with these tax forms will be helpful for. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.